The world tells you a story about the stock market. It's a story of flashing lights, frantic energy, and impossible risk. It's a casino, a grand and glittering place where fortunes are made and lost in the blink of an eye. In this story, you are the gambler. You place your bet on a ticker symbol, a fleeting collection of letters, and you pray. You pray that the digital roulette wheel spins in your favor, that the cryptic charts form the right patterns, that some unseen force of momentum carries your life's savings upward instead of casting it into the abyss. This story is exciting, it's dramatic. It's also the most effective lie ever sold to the investing public, a lie that has systematically separated millions of people from their wealth, their peace of mind, and their dreams of financial freedom. Today, we are going to burn that story to the ground. We are going to replace it with a different one, a quieter, more powerful truth. It's the story of a man from Omaha, Nebraska, who looked at this chaotic casino and saw something else entirely. He saw a collection of businesses, some wonderful, some mediocre, some terrible, and he developed a mental model so simple, yet so profound, that it allowed him to ignore the noise, sidestep the risk, and build one of the greatest fortunes in human history. This model is his final promise to the rational investor. It's the principle that turns a speculative stock into a predictable bond, a gamble into a guarantee. It's the idea that a great business is nothing more than a bond with a coupon that grows every single year. By the end of this journey, you will no longer see yourself as a gambler placing bets. You will see yourself as a capital allocator, a business owner, purchasing predictable streams of future income at a discount. You will transform the stock market from a source of anxiety into your personal engine for wealth building, an engine grounded not in luck, but in logic, safety, and the unassailable power of business reality. This is the safest way to get rich in the stock market, because it isn't about the market at all, it's about the business. Let us begin with the foundational concept, the blueprint that underpins this entire philosophy. We call it the equity bond blueprint. It is the master key that unlocks the entire system of value investing. The idea is to fundamentally reframe what a stock is. It is not a lottery ticket. It is not a piece of code on a screen. A share of stock is a fractional ownership interest in a real, operating business. And what does a business do? A good business, at its core, generates cash, profit, year after year. This stream of cash that belongs to you, the owner, is functionally identical to the coupon payment you would receive from a government or corporate bond. The revolutionary difference, the secret that creates astonishing wealth, is that unlike a bond's fixed coupon, the coupon from a great business grows over time. To truly understand this, we must travel back to a time of crisis, to the year 1976. The air was thick with pessimism. The country was still reeling from the 1973-74 market crash. Stagflation was a household word, and confidence was in short supply. One company that embodied this crisis was the government employees' insurance company, better known as Geico. Today, we know Geico as a dominant force in the insurance industry, a pillar of Berkshire Hathaway's empire, famous for its talking gecko. But in 1976, Geico was on the verge of bankruptcy. It was a corporate train wreck. The company had made a series of disastrous underwriting mistakes. It had chased growth at all costs, underpricing its insurance policies to gain market share. When claims inevitably rolled in at a higher-than-expected rate, the company's finances were gutted. The numbers were terrifying. Geico lost a staggering $126 million in 1975. Its stock, which had traded as high as $61 a share in 1972, had collapsed to just $2 per share in 1976. Wall Street had pronounced it dead. The consensus was unanimous: sell, get out now before it goes to zero. The story was one of failure, of mismanagement, of imminent collapse. This was the casino at its most terrifying, a stock in a death spiral. But Warren Buffett wasn't listening to the story. He wasn't looking at the stock price. He was looking at the business. He had a long history with Geico. He had first bought its stock as a young man at Columbia Business School, After a weekend trip to Washington, D.C., where he had banged on the door of their headquarters until a senior executive, Lorimer Davidson, agreed to speak with him. For hours, Davidson had explained the insurance business to the young, eager Buffett. Buffett learned that the key to Geico's success was its low-cost model. By selling directly to consumers, primarily safe-driving government employees, it cut out the expensive agent network that other insurers relied on. This cost advantage allowed it to offer lower prices and still earn handsome profits. It was, in his words, a brilliant business model. Now, decades later, the business model was still brilliant. The problem wasn't the model, it was the management that had temporarily forgotten how to execute it. So, in the midst of the 1976 panic, Buffett did what he always does. He ignored the stock chart and read the financial reports. He looked past the headline losses and dug into the operational reality. He saw that the company was bleeding money because it had set its prices too low. This was a solvable problem. A new, competent CEO, Jack Byrne, had just been brought in. Byrne's first order of business was to aggressively raise insurance premiums. It would be painful in the short term, as some customers would leave, but it would restore the company to underwriting profitability. Buffett understood this. He understood that the core competitive advantage, the low-cost direct-to-consumer model, was still intact. Once prices were corrected, the business would once again begin to gush cash. He wasn't buying a $2 lottery ticket and hoping it would go up. He was analyzing the future stream of earnings, the future coupon payments from this equity bond. He calculated that with rational pricing, Geico's business was worth vastly more than its market price suggested. He saw a business that could predictably earn tens of millions and eventually hundreds of millions of dollars per year. At a market capitalization of just a few dozen million, he was being offered the chance to buy this future income stream for pennies on the dollar. So he started buying, aggressively. He flew to New York to meet with the brokerage firm handling the panicked selling. He invested $47 million, eventually buying up about a third of the entire company. To the rest of the world, it looked like an insane gamble on a dying company. To Buffett, it was the safest investment in the world. He was buying a bond with a massive and soon-to-be growing coupon for a fraction of its face value. The outcome is now history. Jack Byrne righted the ship, Geico returned to massive profitability, and the stock soared. Buffett's investment became a cornerstone of Berkshire Hathaway's wealth, a multi-billion-dollar testament to the power of the equity bond blueprint. He saw a predictable income stream, where others saw only risk and chaos. The reason this mental model is so powerful is because it directly counters a fundamental flaw in human cognition. It all comes down to a psychological principle known as framing. The way a choice or a piece of information is presented to us, its frame, has a massive impact on the decision we make, even if the underlying facts are identical. For example, if a doctor tells you a surgery has a 90% success rate, you feel confident. If they tell you it has a 10% failure rate, you feel anxious, even though the information is exactly the same. The frame changes everything. The conventional Wall Street frame for a stock is that of a security, or a ticker. This frame primes your brain for speculation. It focuses your attention on price movement, on charts, on daily volatility. It activates the more primitive, emotional, fast-thinking parts of your brain, what psychologist Daniel Kahneman calls System 1. This is the part of your brain that loves a good story, that gets a thrill from gambling, that is susceptible to fear and greed. When you frame your investment as buying TSLA or selling AAPL, you are engaging your System 1 brain. You are, whether you realize it or not, playing in the casino. Buffett's genius was to consciously reject this frame. He created a new one, the stock as a piece of a business, the, quote, equity bond. This frame forces your brain to engage a different system entirely. It activates the slow, logical, analytical part of your mind, System 2. When you ask, what are the 10-year earnings prospects for this business? Or, what is the predictable coupon this enterprise will generate for me as an owner? You are shutting down the gambler and awakening the business analyst. You are no longer concerned with what the price will be tomorrow or next week. You are concerned with the long-term cash-generating power of the underlying asset. This reframing completely changes the questions you ask. The speculator asks, "Where is the stock price going?" The business owner asks, "Is this business earning more money than it was last year?" The speculator asks, "Is there enough hype to push this stock higher?" The business owner asks, "Does this company have a durable competitive advantage that protects its profits?" The equity bond frame acts as a psychological buffer against the madness of the market. It provides an anchor of logic in a sea of emotion. It's a tool for capital preservation because it stops you from making the biggest mistakes, buying into hype and selling into panic. You wouldn't sell a high-quality rental property that was sending you checks every month just because your neighbor offered you 20% less for it than he did last week. That's absurd. Yet that is precisely what millions of investors do every day in the stock market. They sell their fractional ownership in wonderful, cash-gushing businesses simply because a manic depressive market is having a bad day. The equity bond blueprint protects you from this self-destructive behavior by forcing you to see the asset for what it truly is, a claim on a stream of business earnings. So how do we translate this powerful theory into a practical, repeatable process? How do we build the blueprint for ourselves? The first step is to learn how to calculate the coupon of our equity bond. In bond investing, the coupon is clearly stated. For a stock, we have to do a little work. The figure we are looking for is what Buffett calls owner earnings. This is different from the net income, or earnings per share, EPS, that most analysts focus on. Net income can be easily manipulated by accounting conventions. Owner earnings represent the true cash flow that is available to the owners of the business at the end of the year. It's the money you could, in theory, take out of the business without harming its long-term competitive position. The formula is beautifully simple. Owner earnings equals net income, plus depreciation and amortization, minus the average annual amount of capital expenditures required to maintain the business's competitive position and unit volume. Let's break that down. You start with net income, which you can find at the bottom of the company's income statement. Then, you add back depreciation and amortization. These are non-cash charges. The company isn't actually spending this money. It's just an accounting expense, so we add it back to get closer to a true cash figure. This part is easy. The final part is the trickiest but the most important. Subtracting maintenance capital expenditures, or maintenance CapEx. A company has to spend money on property, plant, and equipment just to stay in business, to replace old machines, update facilities, and so on. This is maintenance CapEx. Any spending above this amount is growth CapEx, which is discretionary spending to expand the business. We only want to subtract the maintenance portion because that's the cost of keeping the coupons stable. Unfortunately, companies don't break out maintenance and growth CapEx on their financial statements, so we have to estimate. A simple conservative method used by many value investors is to look at the capital expenditures line on the cash flow statement and average it over the last 7 to 10 years. This smooths out any lumpy, irregular spending and gives a decent proxy for what the company needs to spend just to keep the lights on. Once you have your owner earnings figure, you have the coupon of your equity bond. The next step is to calculate its yield, to see how attractive that coupon is relative to the price you are paying. To do this, you simply divide the company's total owner earnings by its current market capitalization. This gives you the owner earnings yield. This single number is one of the most powerful tools in your investment strategy arsenal. It allows you to compare a stock directly to a bond. If a company has an owner earnings yield of 10%, it's like buying a bond with a 10% coupon. If the U.S. 10-year Treasury bond is yielding 4%, you can immediately see the relative attractiveness. But remember the magic ingredient. With the stock, if it's a great business, that 10% coupon is likely to grow next year, and the year after, and the year after that. This simple calculation, finding the owner earnings yield, is the first crucial step in moving from speculation to a disciplined approach to value investing. It grounds your decision in the reality of business performance and provides a clear metric for assessing value. This is the bedrock of financial security. To fully appreciate the wisdom of this blueprint, we must examine its opposite. We must journey into the heart of the path walked by the 99% of investors who fail to build lasting wealth in the market. This is the path of the antithesis, the path that views stocks not as bonds, but as lottery tickets. There is no more vivid illustration of this than the dot-com bubble of the late 1990s. It was a time of pure narrative, a period when the age-old rules of business and finance were declared obsolete. A new economy had dawned, and in this new paradigm, things like profits and cash flow were considered quaint relics of a bygone era. All that mattered was a good story, a .com at the end of your company name, and the ability to attract eyeballs. The poster child for this delusion was a company called Pets.com. The business model, if you could call it that, was to sell pet supplies online. The company had a charismatic sock puppet mascot. It ran a multi-million-dollar ad during the Super Bowl, and it was the talk of Wall Street. Investors poured money into its initial public offering, IPO, in early 2000. They weren't buying an equity bond. They were buying a piece of the future, a ticket to the new world order of e-commerce. There was just one problem. There was no coupon. In fact, there was a negative coupon. For every dollar of pet food it sold, the company was losing money. Its business model required it to spend a fortune on marketing and warehousing to acquire customers, and it was selling heavy bags of dog food at or below cost, leading to massive shipping expenses. The company was a financial black hole, incinerating cash at an alarming rate. An investor applying the equity bond blueprint would have taken one look at Pets.com's financial statements and run for the hills. The net income was a massive loss. There were no owner earnings to calculate. The owner earnings yield was deeply negative. There was no stream of income to value. There was only a stream of losses. But the investors of the day weren't doing that analysis. They were caught in the story. They saw a rising stock price and assumed it would keep rising. They were practicing what was known as the greater fool theory, the belief that you could pay any price for an asset, no matter how absurd, because there would always be a greater fool willing to pay more. This is the essence of speculation. It untethers investment from business reality and ties it to pure psychology and momentum. We all know how this story ended. The narrative collapsed. The market realized that a business that loses money on every sale is, in fact, worthless. Pets.com, which had a market capitalization in the hundreds of millions, went bankrupt and shut down in November 2000, less than a year after its IPO. Investors who had poured their retirement planning funds into the stock lost everything. This is the brutal consequence of ignoring the blueprint. When you chase stories instead of cash flows, when you buy lottery tickets instead of businesses, you are building your financial future on a foundation of sand. The tide of market sentiment will eventually go out, and you will be left with nothing. This is not a viable investment strategy. It's a recipe for financial ruin. The financial connection between adopting the equity bond blueprint and achieving long-term portfolio growth is not theoretical. It is a mathematical certainty. Let's make this tangible. Imagine two retail investors, both starting their wealth-building journey with $100,000. Investor A follows the path of the 99%. He's drawn to exciting stories, fast-growing tech companies that are not yet profitable. He buys Company Hype, a popular software company that is growing its revenue at 50% a year, but has negative owner earnings. Its stock price is soaring, driven by a compelling narrative about disrupting an industry. Investor B, armed with our blueprint, seeks out an equity bond. She finds Company Steadfast, a consumer goods business that sells products people need in good times and bad. Its revenue is only growing at 6% a year, but it is highly profitable and has a durable brand name. She calculates its owner earnings and finds that it has an owner earnings yield of 8%. The business consistently converts its profits to cash and has a long history of doing so. Over the first year, Investor A feels like a genius. The narrative around Company Hype intensifies, and its stock price doubles. His portfolio is now worth $200,000. Investor B, meanwhile, sees a more modest return. Company Steadfast's business performs as expected, and its stock price appreciates by about 12%. Her portfolio is worth $112,000. Investor A scoffs at Investor B's boring approach, but then a recession hits. Investor sentiment shifts from greed to fear. The narrative around company hype shatters. Investors are no longer willing to fund its losses. They start demanding profits that don't exist. The stock price collapses by 80%. Investor A's $200,000 portfolio plummets to just $40,000, a devastating blow to his financial security. What happens to company Steadfast? People still need to buy its products. Its earnings dip slightly, maybe 5%, but it remains solidly profitable. Its coupon is secure. The stock price falls with the overall market, perhaps by 20%. Investor B's portfolio drops from $112,000 to about $89,600. Now look at their positions. Investor A has suffered a 60% loss of his original capital. Investor B is down just over 10%. More importantly, she owns a business that is still fundamentally sound in generating cash. As the market recovers, company Steadfast's stock will recover with it. Company hype may never recover. It may even go bankrupt. This simple example reveals the profound truth of risk management. The equity bond blueprint is a mechanism for capital preservation. By grounding your investments in a predictable stream of actual cash earnings, you build a portfolio that is resilient to the inevitable storms of the market and the fickle winds of sentiment. You are choosing a path that prioritizes not getting wiped out, which, over the long run, is the single most important factor in successful wealth building. This is how you create a portfolio that lets you sleep at night, a portfolio that reliably compounds toward your retirement planning goals, year after year. Once we have embraced the core idea of a stock as an equity bond, the next logical question is, which stocks qualify? Not all businesses are created equal. A bond issued by the U.S. government is fundamentally different from a junk bond issued by a distressed company. The government bond's coupon is virtually guaranteed. The junk bond's coupon is highly uncertain. Similarly, the coupon or owner earnings of some businesses are highly predictable and reliable, while others are speculative and volatile. Our job as intelligent investors is to focus exclusively on the former. This brings us to our second pillar, the predictability filter. To build a portfolio of safe and reliable equity bonds, we must learn to identify businesses with deep, structural advantages that protect them from the forces of competition. We must find companies with what Buffett calls a durable competitive advantage, or an economic moat. An economic moat is a barrier that protects a company's profits from being competed away. It's what allows a business to earn high returns on capital for long periods of time, making its future earnings stream, its coupon, predictable. The perfect story to illustrate this principle is Buffett's long and incredibly profitable investment in the Washington Post Company. In 1973, in the depths of the same market crash that would later gut Geico, Buffett found another extraordinary opportunity. The market was in a state of panic. Watergate was unfolding, the economy was weak, and investors were dumping stocks indiscriminately. The Washington Post Company, a fine business, saw its stock price fall, along with everything else. Its market capitalization dropped to around $80 million. Buffett, as always, ignored the panic and analyzed the business. He asked himself, what is this company? On the surface, it was a newspaper, but to Buffett, it was something far more valuable. He recognized that the Washington Post held a virtual monopoly in one of the most powerful and affluent cities in the world. If a department store in Washington, D.C. wanted to advertise a sale, or if a family wanted to post a classified ad, they had no real alternative. The Post was the only game in town. This local monopoly gave it immense pricing power. It could raise its advertising rates year after year, and its customers had to pay. This pricing power translated directly into a highly predictable and growing stream of earnings. It was a magnificent economic moat. Buffett calculated that the entire business, which also included Newsweek magazine and several television stations, was worth at least $400 million, and probably more. Yet the market was offering it to him for $80 million. He was being offered a $5 bill for $1. He began buying shares, eventually investing about $11 million to acquire a large stake in the company. He developed a close relationship with its legendary publisher Katharine Graham and took a seat on its board. He wasn't just buying a stock, he was becoming a part owner of a dominant business franchise. He saw the predictable coupon. The newspaper's ad revenues were like a tax on the entire DC economy. As the city grew, the Post's profits would inevitably grow with it. This was the ultimate equity bond. His $11 million investment would eventually become worth over $1 billion, a return of more than 100 times his original capital. This staggering success was not born of speculation or complex financial engineering. It was born from applying the predictability filter. He identified a business with an unassailable competitive advantage that guaranteed a reliable and growing stream of cash flow for decades to come, and he bought it when the market, in its foolishness, had forgotten its value. This is the core of a successful long-term investment strategy. Why do so few investors apply this filter? Why do we consistently chase the exciting, unpredictable new thing instead of the boring, reliable cash generator? The answer lies deep in our cognitive wiring, specifically in two powerful biases: the availability heuristic and recency bias. The availability heuristic is a mental shortcut where we judge the likelihood of an event based on how easily examples of it come to mind. Things that are dramatic, recent, or heavily covered in the media feel more probable than they actually are. In investing, this means that the hot tech stock that just went up 500% and is all over the news seems like a more plausible path to wealth than the decades-old food company that nobody is talking about. Your brain is flooded with easily available examples of people getting rich quick on speculative bets, while the slow, quiet compounding of a boring business rarely makes headlines. Recency bias is a close cousin to this. It's our tendency to overweight recent events and extrapolate them into the future indefinitely. If a stock has gone up for the last 6 months, our brain naturally assumes it will continue to go up. If a particular industry, like electric vehicles or artificial intelligence, is the hot new thing, we assume its dominance is permanent and its growth is limitless. These biases work together to create a powerful siren song, luring investors away from the safety of predictable businesses and onto the treacherous rocks of speculation. They make us believe that this time is different, perhaps the 4 most dangerous words in finance. The predictability filter is a conscious, rational override of these biases. It forces you to ask questions that your emotional brain would rather ignore. Instead of asking, "What's hot right now?" it forces you to ask, "What was this business doing 10 years ago? And what is it likely to be doing 10 years from now?" The goal is to find businesses whose future is, in a word, boring. You want to invest in a company whose products or services are so essential, so ingrained in the fabric of society, that you can have a high degree of confidence they will still be generating profits a decade from now. Think of companies that sell toothpaste, soft drinks, or insurance. Their products don't change much. Their growth might not be explosive, but it is steady and reliable. This focus on the long term and the mundane is a direct assault on the availability heuristic and recency bias. It's a form of financial education that reprograms your brain to value certainty over excitement. It is the core of effective risk management, because the greatest risk is not volatility. The greatest risk is a permanent loss of capital, which is what happens when a company's unpredictable future turns out to be a bad one. Let's build the blueprint for applying the predictability filter. This involves creating a mental checklist to identify companies with durable competitive advantages or strong economic moats. There are 4 primary types of moats that you, as a retail investor or entrepreneur, should look for. The first and most powerful moat is intangible assets. This includes things like brands, patents, and regulatory licenses. A brand like Coca-Cola is a prime example. For over a century, the company has spent billions of dollars building a connection with consumers in their minds. That mental real estate makes people willing to pay a premium for Coke over a generic store brand cola. This allows Coca-Cola to generate consistently high profit margins. To spot this, look for companies with consistently high gross margins compared to their competitors. This indicates they have pricing power, a key sign of a strong brand. The second moat is switching costs. This exists when it is too expensive, time-consuming, or risky for a customer to switch from one provider to another. Think about the bank where you have your checking account. Moving all your direct deposits and automatic bill payments would be a massive headache. You are locked in by high switching costs. In the corporate world, this is even more powerful. Companies that run their operations on software from Microsoft or Oracle are highly unlikely to switch, as it would require retraining their entire workforce and risking massive operational disruption. To spot this, look for companies with very high customer retention rates, often referred to as low churn. The third moat is the network effect. This occurs when the value of a product or service increases as more people use it. A telephone wasn't very useful when only one person had one. A social media platform like Facebook or a credit card network like Visa becomes more valuable to each user as more users join the network. This creates a powerful winner-take-all dynamic, where the largest network becomes virtually unassailable. A key metric to look for here is user growth and engagement. A company whose network is still growing and deepening is strengthening its moat every day. The fourth and final moat is a cost advantage. This is when a company can produce a product or service at a consistently lower cost than its rivals. This can come from proprietary processes, superior scale, or unique access to a low-cost resource. A company like Walmart or Costco uses its immense scale to negotiate lower prices from suppliers, which it then passes on to customers, creating a virtuous cycle that competitors can't match. To spot this, look for companies with consistently higher operating margins than their industry peers. Your blueprint is to take any potential investment and run it through this four-part checklist. Does it have a powerful brand? Are its customers locked in by high switching costs? Does it benefit from a network effect? Does it have a structural cost advantage? The truly great businesses, the ultimate equity bonds, often have more than one. By using this filter, you systematically weed out the weak, the speculative, and the unpredictable, leaving you with a portfolio of elite, fortress-like businesses that are highly likely to deliver that growing coupon for your retirement planning, year after year. As always, the clearest way to see the right path is to study the wrong one. The antithesis of the predictability filter is the common mistake of extrapolating a temporary advantage into a permanent one. It's the failure to ask the crucial question, is this moat real and durable, or is it a mirage? A tragic but powerful example is the story of Research in Motion, RIM, the maker of the BlackBerry. In the mid-2000s, BlackBerry was not just a phone, it was a status symbol, an addiction. Its secure email service and physical keyboard made it the indispensable tool for business executives, politicians, and anyone who needed to be connected. The company looked invincible, it had a beloved brand, and its BlackBerry Messenger service was an early form of a network effect. Investors piled into the stock, believing its dominance was permanent. The stock price soared, making many people rich on paper. But they were failing to apply the predictability filter with sufficient rigor. They mistook a temporary technological lead for a durable competitive moat. The BlackBerry's advantages were built on specific features, not deep, structural barriers. In 2007, Apple introduced the iPhone. It was a fundamentally different product. It offered a full-featured web browser, a revolutionary touchscreen interface, and, most importantly, the App Store. The iPhone platform created its own powerful moats, network effects. Developers wanted to build for the largest user base, and users wanted the platform with the most apps. And switching costs. Once you've bought all your apps and music on iOS, it's hard to leave. Apple wasn't just competing with BlackBerry on features, it was changing the entire game. RIM's management was dismissive. They didn't believe people would want to type on a glass screen. They were trapped in their old way of thinking. Their temporary advantage evaporated almost overnight. Their customers, who were not truly locked in, flocked to the superior iPhone and, later Android devices. The BlackBerry, once the king of mobile, became a relic. The company's profits collapsed, and its stock price fell by over 95% from its peak. Investors who had bet their financial security on the perceived permanence of BlackBerry's lead were financially obliterated. They learned a brutal lesson in risk management. Technological leadership is often the weakest and least durable form of a competitive advantage. The predictability filter would have saved them. It would have forced them to ask the hard questions. Is the BlackBerry brand as strong as Coca-Cola's? Are the switching costs as high as those for a bank? Is the network effect as powerful as a credit card network? The answer to all of these questions was no. The moat was shallow, and a determined competitor with a better idea could, and did, cross it with ease. This is the danger of investing in industries characterized by rapid change. True predictability, the kind that makes an equity bond safe, is most often found in industries that change very, very slowly. The direct financial connection between applying the predictability filter and your long-term portfolio growth is profound. It is the difference between building on bedrock and building on quicksand. Let's model the financial statements of two companies over a 10-year period. Company Moat is a business with a durable competitive advantage, say, a dominant consumer brand. Company No Moat is in a competitive, fast-changing industry with no real barriers to entry. In year one, both companies look good. They both earn $100 million in profit. An investor buys shares in both. Now, let's roll the clock forward. For Company Moat, its brand allows it to raise prices slightly each year, and its market position is secure. Its revenues grow at a steady 5% per year. Because of its advantages, it maintains high and stable profit margins of, say, 20%. After 10 years of this steady, predictable growth, its annual profit has grown to over $160 million. The business is significantly more valuable than it was a decade earlier, and its stock price has followed suit, providing excellent returns for the investor. Now consider Company No Moat. Because there are no barriers to entry in its industry, its high profits attract competitors like sharks to blood. New companies enter the market, offering similar products at lower prices. To compete, Company No Moat is forced to cut its own prices. Its revenue growth stagnates, and its profit margins begin to shrink. From 20% in year one, they fall to 15%, then 10%, and by year 10, they are down to a razor-thin 3%. Its annual profit has fallen from $100 million to perhaps $30 million. The business is fundamentally weaker, and its stock price has likely gone nowhere or, more likely, has fallen dramatically. This is the financial reality of competition. Capitalism is brutal. It is a relentless force that seeks to erode all excess profits. An economic moat is the only defense. When you invest, you are making a bet on a company's ability to fight off this force. By using the predictability filter, you are choosing to bet on the heavily armed fortress, not the undefended village. This directly impacts every aspect of your financial life, from asset allocation to retirement planning. A portfolio filled with company moats is a portfolio designed for steady, tax-efficient portfolio growth and capital preservation. A portfolio filled with company number moats is a portfolio designed for stress, volatility, and ultimately disappointment. The choice is yours. Having mastered the art of identifying a predictable equity bond, we arrive at the third and perhaps most critical pillar of our system, the margin of safety mandate. It is not enough to find a wonderful business. You must buy it at a sensible price. The most wonderful business in the world, if purchased at too high a price, can be a terrible investment. The margin of safety, a concept championed by Buffett's mentor, Benjamin Graham, is the bedrock of value investing. It is the principle of buying an asset for significantly less than your conservative estimate of its intrinsic value. It is the bridge that protects you from bad luck, from errors in judgment, and from the unpredictable turmoil of the world. It is the ultimate form of risk management. For the perfect illustration of this principle in action, we must go back to 1963, to a bizarre and fascinating chapter in financial history known as the salad oil scandal. A company in New Jersey called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, was engaged in a massive fraud. DeAngelis had discovered that he could borrow huge sums of money by using his inventory of salad oil as collateral. The only problem was, he didn't have nearly as much oil as he claimed. His scam was to fill his giant storage tanks mostly with water, with only a few feet of oil floating on top. When inspectors came, they saw the oil and signed off on the inventory. With these fraudulent warehouse receipts, he secured massive loans from dozens of Wall Street firms. One of his biggest creditors was American Express, which had a warehousing division that had guaranteed the receipts. When the fraud was discovered, Allied Crude collapsed, and panic ripped through Wall Street. Everyone assumed that American Express would be on the hook for the massive losses, potentially bankrupting the company. The market reacted with sheer terror. The stock of American Express, a blue-chip company with a wonderful traveler's check and credit card business, was hammered, falling by nearly 50%. This was a classic market panic, driven by fear and uncertainty. Warren Buffett, a young money manager in Omaha at the time, saw the panic as an opportunity. He didn't just read the headlines, he did the work. He applied the margin of safety mandate. First, he needed to determine if the core business was being permanently damaged by the scandal. So he went out and did his own scuttlebutt research. He visited restaurants and banks. He would talk to cashiers, asking them if they were still seeing customers use American Express cards and travelers' checks. He'd buy a pack of gum with the travelers, check to see if the merchant hesitated. He observed that consumer behavior hadn't changed at all. The public still trusted the American Express brand. The scandal was confined to the warehousing division. The immensely profitable payment and travel businesses were unaffected. Next, he calculated the worst-case scenario. He estimated the maximum possible loss from the salad oil fraud. Then he looked at the earning power of the real American Express businesses. He realized that the company's core operations were so profitable that they could cover the entire fraud loss with just a single year's worth of earnings. The market was pricing the company as if it were going to die, but Buffett's analysis showed that it was merely a temporary, survivable wound. He concluded that the intrinsic value of American Express was around $60 per share, yet the market, in its panic, was offering it to him for $35. This was his margin of safety. He was buying a dollar bill for 60 cents. He invested 40% of his partnership's capital into the stock, a massive bet. It became his single greatest investment up to that point. As the company absorbed the fraud loss and its powerful earnings engine continued to churn, the market came to its senses. The stock price soared, making a fortune for Buffett and his partners. He didn't predict the market's recovery. He simply bought a wonderful business at a price so cheap that it provided a massive cushion against error. That is the essence of the margin of safety. The psychological power of this principle cannot be overstated. It is a direct antidote to two of the most destructive biases that plague investors: anchoring and loss aversion. Anchoring is our tendency to rely too heavily on the first piece of information we receive. In a market panic, like the salad oil scandal, the anchor is the terrifying headline, the plunging stock price. Our brains latch on to this anchor and view all subsequent information through that negative lens. Investors in 1963 were anchored to the idea that American Express is bankrupt, and they couldn't see the underlying reality of the profitable business. The process of calculating intrinsic value, which is central to the margin of safety mandate, forces you to create your own anchor. Instead of anchoring to the market's manic price, you anchor to your own rational calculation of the business's worth. This intellectual anchor holds you steady when the emotional tides of the market are pulling you towards a disastrous decision. Loss aversion, identified by psychologists Kahneman and Tversky, is the well-documented phenomenon that for humans, the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. This is a survival mechanism left over from our evolutionary past, but in investing it is catastrophic. It's what makes us sell at the bottom, locking in our losses, just to stop the emotional pain of seeing our portfolio decline further. The margin of safety is a powerful psychological tool to combat loss aversion. When you know you have purchased an asset for 50 cents on the dollar, your emotional response to a price decline is completely different. If the stock you bought at $35 falls to 30, you don't feel panic. You feel excitement. You know the business is worth 60, so the market is now offering you an even bigger bargain. Ben Graham famously said, "The purpose of the margin of safety is to render the forecast unnecessary." By building in a massive cushion, you make yourself resilient to the future's inherent unpredictability. Maybe your growth estimates were too optimistic. Maybe a new competitor emerges. Maybe a global pandemic disrupts the economy. A sufficient margin of safety can absorb these shocks and still allow you to earn a satisfactory return. It transforms investing from a precise art of forecasting into a forgiving business of buying value. It is the key to sleeping well at night, knowing that you have structured your portfolio not for perfection, but for resilience. So how do we, as individual investors, apply this mandate? How do we build the blueprint for calculating intrinsic value and demanding a margin of safety? The most common tool for this is a discounted cash flow, or DCF, analysis. This may sound intimidating, but the concept is simple. The value of any asset is the present value of all the cash it will generate in the future. A DCF model is just a way to systematically estimate that. Let's create a simplified, practical blueprint. Step 1 is to project the company's future owner earnings for the next 10 years. You start with the current owner earnings, which we learned to calculate earlier. Then, you need to estimate a growth rate. This is the most important input, and it requires conservatism. Look at the company's historical growth rate, but also consider the industry's prospects and the strength of the company's moat. For a stable, mature business, a growth rate of 3 to 7% might be appropriate. For a faster-growing company, you might use a higher rate, but be very careful not to get too optimistic. Let's say you project owner earnings growing at 5% per year for 10 years. Step 2 is to choose a discount rate. The discount rate is the annual return you require to compensate you for the risk of the investment. A common approach is to use a rate between 8 and 12%. A higher discount rate is more conservative and will result in a lower intrinsic value estimate. Let's use 10%. Step 3 is to calculate a terminal value. A business, we hope, will continue generating cash well beyond 10 years. The terminal value is an estimate of the value of all cash flows after the initial 10-year projection period. A simple way to do this is to take the owner earnings from year 10 and apply a, quote, perpetuity growth multiple. For a stable business, a multiple of 10 to 15 is often used. So if year 10 owner earnings are $100 million, a multiple of 12 would give you a terminal value of $1.2 billion. Step 4 is the discounting process. You take each of your 10 years of projected owner earnings plus the terminal value, and you discount each of them back to today's dollars using your chosen discount rate. The formula for this is present value equals future value slash 1 plus discount rate, caret number of years. You then sum up all these present values. That final sum is your estimate of the company's intrinsic value. Step 5 is the margin of safety mandate itself. You take your calculated intrinsic value and compare it to the company's current market price. You should insist on a significant discount. Ben Graham recommended a 50% margin of safety. So if your DCF analysis tells you a company is worth $100 per share, you should only be willing to buy it at $50 per share or less. This blueprint is not about finding a precise, perfect number. It's about getting a reasonable estimate and then applying a massive buffer. It forces a discipline of patience and rationality onto your investment process. It makes you a value buyer, not a price taker. This methodical process is the heart of a sound investment strategy for any retail investor looking to build real, lasting wealth. To see the devastating consequences of ignoring this mandate, We need only look to the antithesis, the Nifty 50 era of the early 1970s. This was a group of about 50 large-cap blue-chip American companies that were seen as one-decision stocks. You just buy them and never sell them. The list included wonderful businesses like Coca-Cola, IBM, McDonald's, and Polaroid. The theory was that these were such high-quality companies with such certain growth prospects that you could pay any price for them. Wall Street fell in love with this idea. Institutional investors, from pension funds to mutual funds, piled into the Nifty 50, pushing their valuations to absurd levels. Companies like Polaroid and Xerox were trading at over 50 times their annual earnings. To put that in perspective, that's like buying an equity bond with a coupon yield of just 2%, far below what you could get from a safe government bond at the time. The investors in the Nifty 50 had correctly identified wonderful businesses. They had found the predictable equity bonds. But they completely ignored the margin of safety mandate. They were paying $1 for maybe 40 cents worth of intrinsic value. They believed the growth of these companies would be so spectacular that it would justify the sky-high prices. This was the ultimate violation of value investing principles. The day of reckoning came with the 1973-74 market crash. The economy soured, and the growth rates of even these great companies slowed down. It turned out they weren't immune to economic cycles after all. As their growth prospects were revised downward, their stock prices, which had been priced for perfection, utterly collapsed. From their peaks, Polaroid fell by 91%. Xerox fell by 71%. Avon fell by 86%. Investors who had bought at the top suffered catastrophic, life-altering losses. The tragic irony is that they owned some of the best businesses in the world, but because they paid a price that left no room for error, no margin of safety, they were financially ruined. It took more than a decade for many of these stocks to get back to the prices they had reached in 1972. The Nifty 50 story is the ultimate cautionary tale. It proves that even the best asset can be a terrible investment if the price is wrong. It is a stark reminder that in investing, the price you pay is one of the most important determinants of your future return. Ignoring the margin of safety is not just bad risk management. It is a direct path to the destruction of your capital. Let's quantify the staggering financial impact of adhering to the margin of safety mandate. Imagine two investors who both correctly identify a wonderful business. Let's say they analyze a company and both agree that its intrinsic value is $100 per share. The stock is currently trading at $95 per share. Investor A, who is impatient and ignores the mandate, says, "It's a great company, and it's trading a little below my estimate of its value. I'll buy it now." He invests $100,000, buying 1,052 shares at $95 each. Investor B, a disciplined practitioner of our blueprint, says, "This is a wonderful company worth $100, but there is no margin of safety at 95. I will wait for a better opportunity, for Mr. Market to offer me a real bargain." She puts her $100,000 in short-term treasury bills, earning a modest return, and she waits. 6 months later, a market correction occurs. Fear grips investors, and our target company's stock, despite its business performing perfectly well, falls to $50 per share. Investor A now sees his position, which he bought for $100,000, is worth only $52,600. He is down nearly 47% and is feeling sick with loss aversion. He is tempted to sell just to stop the pain. Investor B, on the other hand, sees her opportunity. The business is still worth $100 a share, but now it's being offered at a 50% discount. Her margin of safety is here. She takes her capital and buys 2,000 shares at $50 each. Now let's fast forward 5 years. The market has recovered, and the stock is now trading at its intrinsic value of $100 per share. Let's look at their outcomes. Investor A's 1,052 shares are now worth $105,200. His total return over roughly 5.5 years is a measly 5.2%. He has barely beaten inflation. Investor B's 2,000 shares are now worth $200,000. She has doubled her money. Her annualized return is exceptional. This is the same company. The only difference was the entry price. The margin of safety is the turbocharger for your returns. By buying cheap, you get three things working in your favor. First, you have downside protection. Second, you have a higher coupon yield on your purchase price. Third, you get a potential tailwind from the valuation itself returning to normal. This isn't just about beating the market. It's about fundamentally altering the risk-reward equation of your portfolio. It's the most powerful tool for ensuring that your journey toward financial freedom is not just successful, but also safe. We have now established our foundation. We know how to think of stocks as equity bonds, how to filter for the most predictable ones, and how to buy them with a margin of safety. Now we must confront the greatest enemy of this rational approach, the constant, deafening noise of the market itself. This brings us to our fourth pillar, the fallacy of the ticker tape. The ticker tape, whether it's a scrolling line on a TV screen or a constantly refreshing number in a brokerage app, is the modern embodiment of Mr. Market, Ben Graham's famous parable. Mr. Market is your manic-depressive business partner. Every day he shows up and offers to either buy your shares or sell you his, at a price that reflects his mood, which swings wildly from euphoria to despair. Most of the time, his prices are nonsensical. The fallacy is believing that his daily quotes have anything meaningful to say about the underlying value of your business. The intelligent investor learns to use Mr. Market as a servant, not a guide. You exploit his pessimism to buy cheap and ignore his euphoria. The ultimate masterclass in this mindset was delivered by Warren Buffett on October 19, 1987, a day that went down in history as Black Monday. The Dow Jones Industrial Average plunged 508 points, a staggering 22.6% loss in a single day. It was, and still is, the largest one-day percentage drop in the market's history. Panic was absolute. The financial system seemed to be on the brink of collapse. People who had their life savings in the market were watching their net worth evaporate in a matter of hours. The airwaves were filled with breathless commentary, with experts predicting the end of capitalism as we knew it. Journalists called Warren Buffett in Omaha to get his reaction. They expected to hear fear, concern, maybe even panic from the nation's most famous investor. Instead, they got classic Buffett. He was calm, rational, and completely unfazed. He famously told the press, quote, "We went to work this morning, and we'll go to work tomorrow." He explained that the crash was a market event, not a business event. He asked a simple question. Were the long-term earnings prospects of Coca-Cola, one of his major holdings, 22% worse today than they were yesterday? Of course not. People were still going to drink Coke. Was the Washington Post's business 22% less valuable? No. Its moat was still intact. The coupons on his equity bonds were safe. The underlying value of his businesses had not changed one bit. All that had changed was the price Mr. Market was screaming at him. To Buffett, a market decline is an opportunity, not a tragedy. It's a sale at the department store. It's a chance to buy more of the wonderful businesses you love at even cheaper prices. He didn't sell a single share on Black Monday. In fact, in the days that followed the crash, he was a voracious buyer, picking up shares of his favorite companies that panicked investors were throwing away. He saw the fallacy of the ticker tape for what it was, a mass delusion, a temporary fit of insanity that had no bearing on the long-term reality of business value. His refusal to panic, his ability to separate the wild gyrations of the market from the steady progress of his businesses, is a core reason for his incredible success. He has trained himself to see a plunging stock price not as a threat but as an opportunity. This ability to remain calm in a storm is not a superpower, it's the result of consciously fighting against powerful, hardwired psychological biases. The two main culprits are herd mentality and myopic loss aversion. Herd mentality, or social proof, is our deep-seated instinct to follow the crowd. In our evolutionary past, this was a valuable survival trait. If everyone in your tribe suddenly started running, it was a good idea to start running too, without stopping to ask why. it probably meant a predator was near. But in the modern financial world, this instinct is deadly. When the ticker tape is a sea of red and the news is filled with panic, our herding instinct screams at us to sell, to do what everyone else is doing. It takes immense psychological strength to stand apart from the herd and say, "No, the herd is wrong." The ticker tape is the digital shepherd that leads the herd of investors off a cliff. Myopic loss aversion is an even more insidious force. We've already discussed loss aversion, the fact that losses cause more pain than gains cause pleasure. The myopic part refers to our tendency to evaluate our portfolios over very short time horizons. Technology has made this infinitely worse. With brokerage apps on our phones, we can check our portfolio's value every minute of every day. Each time we see a small loss, we experience a pang of that amplified pain. The cumulative effect of these thousands of tiny emotional paper cuts can be overwhelming. It grinds down our resolve and eventually leads to a capitulation, where we sell just to make the pain stop. This is why the typical retail investor's returns are so poor. They are constantly being whipsawed by their own emotions, triggered by the relentless feedback loop of the ticker tape. Buffett's approach is the perfect antidote. By focusing on the business, not the price, he lengthens his time horizon. He's not evaluating his investment on a daily or weekly basis. He's thinking in terms of years and decades. He is effectively blind to the myopic pain of short-term fluctuations because he is not playing that game. He has opted out. He understands that the daily stock price is just the opinion of the crowd on that particular day. The long-term value of the business is a matter of economic fact. By choosing to focus on the fact and ignore the opinion, he builds a psychological firewall that protects him from the destructive forces of herd mentality and myopic loss aversion. How can you build the same psychological firewall? You need to create your own blueprint for ignoring the noise. I call it the business owner's dashboard. This is a practical tool you can create to completely reframe how you track your investments. Instead of opening your brokerage app every day, you are going to build a simple spreadsheet or document for each company you own. This dashboard will not include the current stock price. In fact, you should make a commitment to only check the stock price of your holdings once a quarter or even once a year. The purpose of this dashboard is to force you to think like a business owner, not a stock trader. So what goes on this dashboard? First, the key operational metrics of the business. Every quarter, when the company reports its earnings, you will update your dashboard with the following information: quarterly revenue and its year-over-year growth rate, gross and operating profit margins and whether they are expanding or contracting, the company's return on equity and return on invested capital, and the total debt on its balance sheet relative to its equity. Second, you will include a section for qualitative updates. Read the quarterly and annual reports. Listen to the conference calls. In this section, you will write a few bullet points summarizing what management said about the business's performance. Are they gaining market share? Is their competitive moat getting stronger or weaker? What are their plans for capital allocation? By diligently updating this dashboard every 3 months, you are training your brain to focus on what actually matters, the underlying performance of the business you own a piece of. Your emotional state will no longer be tied to the random, chaotic movements of the stock price. Instead, it will be tied to the slow, steady, and far more meaningful progress of the business itself. If revenues are up, margins are stable, and the moat is strong, you will feel confident, regardless of what the stock price did that quarter. If you see signs of deterioration in the business fundamentals, that is your signal to reevaluate your investment, not a random 10% drop in the stock price. This business owner's dashboard is a powerful tool for behavioral change. It is a commitment to a different investment strategy, one based on facts, not feelings. It is how you, the retail investor, can achieve the same Zen-like calm that allows the masters of value investing to thrive amidst the market's madness. The antithesis to this disciplined, business-focused approach is the world of the day trader, the momentum chaser, the investor caught up in the meme stock mania we've seen in recent years. This is the ultimate expression of the fallacy of the ticker tape. Consider the story of the GameStop saga. Here was a brick-and-mortar video game retailer with a deteriorating business model. Its fundamentals were poor and getting worse. An analysis using our equity bond blueprint would have immediately disqualified it as an investment. There was no predictable, growing coupon. Yet, a large group of retail investors, organized on social media platforms, decided to buy the stock en masse. Their reason for buying had nothing to do with the business. It was a narrative, a story about fighting back against Wall Street hedge funds that were shorting the stock. The stock price became completely detached from any semblance of business reality. It soared from under $20 to nearly $500 a share in a matter of weeks. The ticker tape was all that mattered. People were glued to their screens, watching the price action, caught in a whirlwind of greed, excitement, and a sense of belonging to a movement. They were not investing. They were participating in a collective psychological event. This is the path of the 99% at its most extreme. The focus is entirely on price, momentum, and narrative. Business fundamentals are not just ignored, they are actively scorned as irrelevant. The emotional experience is a roller coaster. The highs of seeing your position double in a day are matched by the terrifying lows of watching it get cut in half an hour later. It is an experience designed to trigger every cognitive bias in the book: herd mentality, fear of missing out, overconfidence. And, as is almost always the case, it ended in tears for most. The stock price eventually collapsed, as it had to, because the stock price can, for a time, detach from reality, but it cannot do so forever. Those who bought near the top were financially devastated. They were left holding shares of a struggling business that were worth a tiny fraction of what they paid. They learned the hard way that the ticker tape is a fickle and dangerous master. When you worship at its altar, you are far more likely to end up a sacrifice than a savior. This is the stark choice every investor faces. Will you be a business analyst or a ticker tape watcher? Your long-term financial security depends entirely on your answer. The direct financial connection between ignoring the ticker tape and enhancing your portfolio growth is one of the most well-documented effects in finance. It all comes down to avoiding the big mistakes. Let's compare the financial journey of two investors over a 10-year period that includes a significant bear market, like the 2008 financial crisis. Investor A is our ticker watcher. He checks his portfolio daily. He gets nervous when it goes down and euphoric when it goes up. When the 2008 crisis hits, he watches in horror as his portfolio, which was worth $100,000, drops to $90,000, then $80,000, then $70,000. The pain of myopic loss aversion becomes unbearable. He tells himself, "I just need to get out and wait for things to calm down." He sells everything at the market bottom. In early 2009, his portfolio now worth only $50,000. He has locked in a 50% loss. He then sits in cash, waiting for a clear sign that the recovery is real, but the market recovers quickly and powerfully from the bottom. By the time he feels confident enough to get back in, a year later, the market has already doubled. He buys back in, but he has missed the most explosive part of the recovery. His long-term returns are permanently crippled by this one catastrophic, emotionally driven decision. Investor B is our business owner. She follows our dashboard approach. She knows she owns fractional stakes in a dozen wonderful businesses. When the crisis hits, she sees her portfolio's quoted value decline, but she doesn't panic. Instead, she opens her business owner's dashboard. She reads the reports from her companies. She sees that while their profits are down temporarily due to the recession, their competitive moats are intact. Coca-Cola is still selling soda. Procter & Gamble is still selling soap. Their long-term earning power is not permanently impaired. She sees the crisis for what it is: Mr. Market in a fit of depression, offering her great businesses at silly prices. If she has spare cash, she buys more. If not, she simply does nothing. She holds on. When the market recovers, her portfolio recovers with it. Because she never sold, she participates in 100% of the rebound. Over the 10-year period, her portfolio fully recovers and goes on to new highs, generating a healthy return that keeps her well on track for her retirement planning goals. The difference in their final net worth is not just a few percentage points, it can be a factor of 2 or 3. Investor A's panicked sale was a self-inflicted wound that may take him decades to recover from, if ever. The single most important factor in long-term investing success is not picking the perfect stocks. It is having the behavioral discipline to stick with your strategy and avoid being scared out of the market by the fallacy of the ticker tape. We have arrived at the final and most exhilarating pillar of our framework. It is the element that takes our safe, predictable equity bond and transforms it into a wealth-building machine of incredible power. This is the concept that truly separates the equity bond from a regular bond. It is the reason this strategy is not just about capital preservation, but about achieving exponential portfolio growth. This is Pillar 5, the compounding coupon. A normal bond pays you a fixed coupon, say 5%, year after year. It's safe and predictable, but it never grows. A great business, our equity bond, is different. It earns a certain amount of cash each year, its coupon, but it typically only pays out a portion of that cash to shareholders as a dividend. The rest, the retained earnings, is reinvested back into the business to generate future growth. If management is skillful, they can reinvest that capital at a high rate of return. This means that next year's coupon will be bigger than this year's, and the year after that it will be bigger still. This is the compounding coupon, and it is the rocket fuel of wealth building. There is no better illustration of this principle than Buffett's 1972 purchase of See's Candies. Alongside his partner, Charlie Munger, he bought the California-based chocolate company for $25 million. At the time, See's was earning about $4 million a year before taxes. Many people thought he overpaid, but Buffett and Munger saw something others missed. See's was a phenomenal business. It had a beloved brand, incredible customer loyalty, and pricing power. It was an equity bond with a very reliable coupon. But the true magic of See's was its capital dynamics. The business was so good that it required very little additional capital to grow. It didn't need to build expensive new factories or fund massive research projects. Growth came from opening a few new stores and from the priceless word-of-mouth advertising of its happy customers. This meant that almost all of the profit the company generated each year was free cash flow. It was the coupon that could be taken out of the business without harming its operations. Over the years, See's Candies became a gusher of cash for Berkshire Hathaway. That initial $4 million in pre-tax earnings grew and grew. By 2011, it was earning $87 million a year. Over the decades, it had produced over $1.6 billion in total pre-tax earnings for Berkshire, all on an initial investment of just $25 million and with very little additional capital required. What did Buffett do with this ever-growing coupon from See's? He didn't just let it sit in a bank account. He took that cash and redeployed it, allocating it to purchase other wonderful businesses, like his massive stakes in Coca-Cola and American Express. The coupon from See's Candies was used to buy other equity bonds with their own compounding coupons. This is the ultimate engine of wealth creation. You buy a business that produces a growing stream of cash, and then you intelligently reinvest that cash into other assets that also produce growing streams of cash. It is a virtuous cycle of compounding that over time produces almost unbelievable results. See's Candies taught Buffett the power of a great brand and the beauty of a business that requires little capital. It was a crucial lesson in his journey from being a classic cigar-butt value investor buying mediocre businesses at dirt-cheap prices to a true capital allocator buying wonderful businesses at fair prices. The reason the power of the compounding coupon is so often underestimated is due to another deep-seated cognitive flaw, the exponential growth bias. Our brains evolved in a world that was largely linear. If you walk for an hour, you cover a certain distance. If you walk for 2 hours, you cover twice that distance. We are naturally programmed to think in straight lines. Exponential growth, where something doubles at regular intervals, is deeply counterintuitive to us. There's a famous riddle that illustrates this. If you have a pond with a lily pad that doubles in size every day, and it takes 30 days to cover the entire pond, On what day is the pond half covered? The answer, which surprises most people, is day 29. For the first 28 days, the growth seems slow and manageable. Then, in one final day, it explodes to fill the remaining space. This is the nature of compounding. The early years of a compounding journey feel slow, almost disappointingly so. But in the later years, the growth becomes explosive and life-changing. When an investor sees a company whose earnings are growing at, say, 15% a year, their linear brain struggles to grasp the long-term implications. They might think, okay, in 5 years, the earnings will be 75% bigger. But that's linear thinking. The reality is that after 5 years of compounding at 15%, the earnings will have more than doubled. After 10 years, they will have quadrupled. After 20 years, they will be 16 times larger. The compounding coupon of a great equity bond harnesses this mathematical force. Each year's retained earnings are added to the capital base, and the next year's growth is calculated on this new, larger number. The coupon doesn't just grow, the rate of its growth accelerates. Understanding this on a deep, intuitive level is what separates the amateur from the professional in the world of asset allocation. It's what gives you the patience to hold on to a wonderful business for decades, allowing the magic of compounding to do its work. It's the ultimate financial education, learning to let the unstoppable force of exponential math work for you rather than against you through things like credit card debt. So how do we identify these compounding machines? What is the practical blueprint for finding companies with truly growing coupons? The key is to look not just at the growth in earnings, but at how efficiently the company is achieving that growth. The ultimate test is what is known as the return on retained earnings calculation. This is a simple but profoundly insightful test that Buffett himself has written about. Here's how you do it. Step 1. Look at a company's financial statements over a long period, ideally 10 years. Find the earnings per share (EPS) from 10 years ago and the EPS for the most recent year. Calculate the total increase in EPS over that decade. For example, if EPS went from $1 to $3, the increase is $2. Step 2. For that same 10-year period, go through each annual report and find the amount of earnings that were retained by the company each year. The retained earnings per share is simply the EPS minus the dividend per share. Sum up the total retained earnings per share over the entire 10-year period. Let's say the company earned a total of $15 in EPS over the decade and paid out $5 in dividends. The total retained earnings would be $10 per share. Step 3. This is the crucial step. Divide the total increase in EPS from Step 1 by the total retained earnings per share from Step 2. In our example, we would divide the $2 increase in EPS by the $10 of retained earnings. This gives us a result of 20 cents. This means that for every $1 the company retained and reinvested in its business over the last decade, it generated an additional 20 cents of annual earnings. This 20% return on retained earnings is a measure of management's skill at capital allocation. This is how you verify that the coupon is truly compounding. You are looking for companies that can consistently reinvest their retained earnings at high rates of return. A company that can pass this test with a high number, say over 15%, is a true compounding machine. It is a business that is skillfully turning today's profits into tomorrow's even larger profits. This simple test cuts through all the noise and narrative and gets to the heart of what creates long-term value. It's a powerful tool for any entrepreneur or investor seeking to identify the elite businesses that are capable of generating extraordinary portfolio growth over the long run. Finally, we must examine the antithesis, the flawed path that leads many investors astray in their search for income and growth. This is the dividend trap. Many people, particularly those focused on income investing for their retirement planning, are naturally attracted to stocks with high dividend yields. On the surface, it makes sense. A stock paying a 6 or 8% dividend looks like a bond with a very attractive coupon. The problem is that a dividend is not a promise. It's a choice. And sometimes companies make bad choices. The dividend trap is when an investor is lured in by a high yield, without investigating whether that dividend is sustainable or healthy. A common scenario is a company in a declining industry. As its business deteriorates, its stock price falls. As the price falls, its dividend yield mathematically goes up, making it look more and more attractive to yield-hungry investors. But the company is funding this high dividend not from a growing stream of profits, but by slowly liquidating itself. It might be taking on debt to pay the dividend, or it might be starving the business of necessary capital expenditures, failing to maintain its plants and equipment. In this case, the coupon isn't a sign of health, it's a symptom of decay. The investor who buys this stock for its high yield is likely to see two terrible things happen. First, the underlying business will continue to decline, causing the stock price to fall further, eroding their capital. Second, eventually, the company will be forced to cut the dividend, at which point the primary reason for owning the stock evaporates, leading to another catastrophic drop in the share price. This is a catastrophic failure of risk management. It's a focus on the yield of today at the expense of the safety of tomorrow. The compounding coupon framework protects you from this trap. It forces you to ask not just, what is the dividend, but where is the dividend coming from? Is the underlying business healthy and growing? What is the company's return on the earnings it retains? A lower dividend yield from a company that is retaining capital and reinvesting it at 20% is infinitely superior to a high dividend yield from a company whose core business is shrinking. The first is a recipe for wealth building. The second is a recipe for capital preservation failure. The direct financial connection between harnessing the compounding coupon and achieving financial freedom is the most dramatic in all of finance. This is where the numbers become truly breathtaking. Let's run a 30-year projection for two investors, each starting with a $100,000 portfolio. Investor A takes the safe income investing approach, the path that often leads to the dividend trap. He builds a portfolio of high-yield stocks and bonds that provides him with a 6% annual coupon. He lives off this income, so there is no growth or reinvestment. After 30 years, assuming his principal is preserved, which is a generous assumption for many high-yield stocks, his portfolio is still worth $100,000. He has generated a steady stream of income, but his wealth has not grown. Investor B uses our equity bond blueprint to build a portfolio of compounding machines. Her portfolio has a lower initial owner earnings yield, say 4%, but her companies retain most of their earnings and are able to reinvest them to grow their coupon at an average rate of 12% per year. She reinvests all dividends and allows the businesses to work their compounding magic. In the early years, the growth seems slow. After 5 years, her portfolio might be worth around $176,000. After 10 years, it's worth about $310,000. Investor A might still feel his approach is safer. But then, the exponential nature of compounding takes over. After 20 years, Investor B's portfolio is worth $964,000. And after 30 years, her initial $100,000 investment has grown to over $2.9 million. The difference is not just large, it is life-changing. It is the difference between a retirement of scraping by and a retirement of true financial freedom and security. This is the power you are unlocking when you shift your mindset. You are moving from the linear world of fixed coupons to the exponential world of compounding coupons. This is the final promise of value investing. It is not just the safest way to invest. Over the long run, it is also the most powerful. You have now journeyed through the 5 pillars of this powerful mental model. You have acquired a complete system for thinking about the stock market, not as a casino, but as a collection of businesses. You learned the equity bond blueprint, reframing a stock as a claim on a stream of growing earnings. You learned to apply the predictability filter, focusing only on businesses protected by durable competitive advantages. You mastered the margin of safety mandate, the crucial discipline of buying these wonderful businesses only when they are on sale. You have built a psychological firewall against the fallacy of the ticker tape, learning to focus on business reality instead of market noise. And finally, you have understood the incredible power of the compounding coupon, the engine that transforms this safe strategy into an unstoppable force for wealth building. This is more than just information. It is a fundamental upgrade to your financial operating system. You now possess the intellectual tools to navigate the markets with confidence, to protect your capital, and to systematically grow your wealth over time. But it is crucial to understand that what you have just mastered, as powerful as it is one critical component in a much larger interconnected network of mental models that the world's greatest investors use to make decisions. The framework of the equity bond is the foundation, but there are other models that bolt onto it, that amplify its power, that allow you to handle different situations and different types of assets. You've built the engine, but to complete the vehicle you need the chassis, the steering, the navigation system. The video that is now appearing on your screen is not a random recommendation. It is the next piece of the map. It is the link that connects what you have just learned about business analysis to the broader concepts of portfolio construction and behavioral finance. It addresses the next logical question that arises once you begin to implement this strategy. Think of it this way. What you have learned today gives you the ability to identify the perfect investment. The video on your screen will give you the wisdom to know what to do with it once you find it. It is the bridge from theory to practice, from knowing the path to walking the path. The choice to click is not just about watching another video. It is a decision about who you want to become. Are you a passive consumer of information, or are you an active builder of your own mental arsenal? The journey to becoming a truly sophisticated investor, one who operates with clarity and control, is a step-by-step process of assembling these critical models. You have just taken the most important step. The next one is right in front of you. Continue your ascent. Complete your arsenal. Click on the next video and secure the missing link.